All right. Today is Sunday, June 9th. This is a recap for the stock market activities this week and an outlook for the week to come. And folks, I got a good one for you tonight. And greetings from the heat dome in the southwest, which is now stretching in Nevada, Arizona, huge parts in California, even though I was in Santa Monica over the weekend and it was pretty cool. June gloom is still going on over there. See, a lot of folks don't know that, specifically European friends. When they used to live in Southern California, they'll come to visit in June and all of a sudden it doesn't look any different than Europe. You might as well have stayed in Germany. So just a tip for you. You want to visit, it's July, August, September. Otherwise, we got the phenomenon of May gray and June gloom. Not a good time to visit California. But before we begin, folks, we noticed that YouTube been demonetizing all of our public videos. Pretty much every single video we produce gets demonetized for the silliest reasons, sometimes for no reasons at all. We know why they're doing this. It's not something new, and this is why we decided to go with a membership model versus relying on advertising money. And this show, just my 2 cents. I think it's going to get demonetized too. Matter of fact, I'm going to bet on it because it's a little R-rated. So do me a favor, if you want to help us out, become a member. You can do it here on YouTube, but if you don't want to feed the oligarchy, you can do it in Patreon. Links in the description. And now that I hyped the show, let's just dive right into it, folks. You see, this economy and this stock market is not your father's economy and your father's stock market. In the old days, you passed a winner to your fellow citizen. Hey, this house, this stock has been good to me, but I gotta move on now. I got different goals. I hope it's gonna be good to you as it was good to me. Good luck. Not anymore, though. It feels that in this economy, everybody wants to stab each other in the back. Somebody wants to unload their home and screw the buyer. Somebody wants to unload their overvalued stocks and screw the buyer. It has become a zero-sum game. Somebody wins, somebody loses. It wasn't supposed to be this way. It wasn't supposed to be predatory. It was supposed to be free economy. Free market, but not anymore. Hold that thought because we're going to talk about it in details, and I'm going to connect the dots for you. But let's begin with the macro data that we got on Friday. And what else? It was the big kahuna day. It was the payrolls. And the headline is right here. U.S. job gains totaled 272,000 in May. More than expected. Of course, this is before the revisions. Now, you got to remember, good news like this is not good news for the market because the market is looking for bad news. Not so bad, though, not indicative of a recession, but bad enough. Enough for what? Bad enough for the Fed to cut rates. That's what the stock market cares about. So with a headline like this, what was the reaction that we've seen right away? The dollar and bond yields spiked significantly higher, which again, algorithmically, it was supposed to drop stocks down. And it dropped a lot of stocks down. Not the indices though. Those were pretty much flattish for the day. Why? Because the cooks at the Bureau are now in the political season. It's the elections. They have to pump the administration. What is the sweet balance in the recipe? You give us a hard jobs number so the administration can brag. They can go on Twitter and say, hey, look at how many jobs we created. Of course, I think the gaslighting will backfire, but that's a topic for another conversation. But we know that a hard jobs number means inflation, specifically when you have wages also beating expectations. That is indicative that wages will lead to higher inflation. But the cooks at the Bureau, if you look at the last paragraph, it reads at the same time, the unemployment rate rose to 4%, the first time it has breached that level since Jan 22. So if you thought that the jobs number is too hard and inflationary, the cooks gave you another reason to say, but the unemployment rate went higher. Well, gee, how did that happen? If the economy is creating more jobs than expectations, why do we see the unemployment rate moving higher? Oh, the labor participation rate went down a tick. This is the sweet spot. They can say that, look, unemployment moving higher, so you can't really hike rates because you got a higher jobs number or higher wages data. The question is it good enough for a cut? Because we have the FOMC coming out this week. Was the report good enough for a cut? The answer is, of course not. It's good enough for no hike, but it's not good enough for a cut as the ECB did this week. Higher wages, commodities been fluctuating in wild moves. Any cuts right now will risk higher inflation before the elections. So we think that in this FOMC meeting this week, which will be the last window for the Fed to cut rates before the elections, they do it later, it will be looked at as political. We think that the Fed will keep it as it is, and that will be the decision all the way till the elections until what? Until something breaks. Now, is it concerning that we see the unemployment rate moving higher? Well, anecdotally, if you see in different sectors and the evidence that you guys provide to me every day, Yes, we see folks losing their jobs, but they can cook this data too by playing with the labor participation rate. If it becomes too uncomfortable for the administration that the unemployment rate is moving higher to 4, 4.2, 4.5, they can play with the recipe in labor participation and push it back down. Did we say that labor participation rate went down? We're going to revise it higher now. It happens all the time, and this is why nobody has any trust in the data coming out of the government. But there are signs to be worried about in this economy, about the destination we're heading to. What could lead to sustainable increase in the unemployment rate? Not playing with the labor participation rate, but actual unemployment, folks losing their jobs. How can we get there in this economy? If consumer spending gets weaker, which means that corporate revenues and margins will get weaker. And in response, they have to lay off their employees. And if this becomes a phenomenon in the economy, the consumer weakness, we will see consistent job losses. And of course, when we have job losses, weaker consumer spending, that will also impact the valuation of the stocks of these companies negatively in the market. We have talked in details in previous videos about the consumer weakness that we see, and it is happening because of higher rates and higher inflation for about 2 years now. And trouble is brewing in this economy, which will lead us to that destination eventually. If you read the article by the Wall Street Journal written by Nick Timiraos, who's a kiss ass for the Fed, but of course he has to balance it with, but don't get too comfortable. I'll take that over Steve Leisman's consistent ass kissing of the Fed with no criticism at all. But anyhow, Nick says why the recession still is not here. It is the expansion that keeps defying expectations, thanks to steady hiring and strong spending. But don't get too comfortable. Of course, it's not a well-written article, to be honest with you, because he argues, the net worth of Americans went higher, and that's why we're holding. The increase in net worth is tied to the real estate and stock market bubbles. That'll go on, but when things crash, the net worth will crash too. So what is the point of this data as indicative of the health of the economy? Furthermore, when we talk about households' net worth, when you lump you and me with Bill Gates and Jeff Bezos, we're going to look filthy rich on paper. You take Bezos and Gates out of the picture, and it's going to look drastically different. But what Nick brings out here is the share of credit card debt past due. This has been increasing, now surpassing the highs of the pandemic. And it is mimicking the surge that we've seen in credit card delinquencies before the Great Recession in 2009. And hence, don't get too comfortable. Higher rates will still be with us. We just got a hotter jobs and wages report, which means the Fed is not going to be able to cut rates. So higher rates will stay with us for longer. As the debt continues to accumulate, it'll cost the consumer more and more to service the debt, which means that they're going to reduce their spending more and more. This feedback will reach corporations. Their revenues will go down. Net income will begin to suffer, and the only remedy, the easiest one, is get rid of employees. We've seen that a little bit in 22 in the tech sector, but not other sectors. As this phenomenon continues, we will see it inclusively in every sector in the economy. And the question now becomes, when we get there, not if, but when we get there, how would the government and the Federal Reserve rescue the economy? Because right now, and we go back to the predator and prey analogy, we have the Treasury Department, led by Janet Yellen, and she's choosing short-term gains in exchange of long-term suffering and misery for this country and its people. How is she doing this? Back in November, we got the announcement by Janet Yellen that she's going to reduce the issuance of longer-term bonds, the 10-year note, all the way to the 30-year bond. She's going to reduce the issuance of these longer-term T-bills. Well, why would she do that? Because we are still running a huge budget deficit. How are we going to finance the budget deficit if we don't increase taxes? Well, here's the answer. In exchange of reducing the issuance of T-bills from the 10 to the 30, she's going to increase the issuance in the shorter end of the yield curve, the 1-month bill, 3-month bill, 6-month bill. And again, we talked about this in details in a previous video, but we're just connecting the dots here. Why did Janet Yellen do this? The answer is, if she just issued 10-year notes and 30-year bonds, increasing the supply means reducing the price of these bonds, which means we will see higher yields in the 10-year all the way to the 30. Well, higher yields, not good for the market because it restricts financial conditions. Not good for the banks. Remember the banks? With their losses in assets held till maturity. If yields go higher, they're going to blow up. So Janet wants to delay that till after the elections. So she played this game of, we're going to try to suppress the rates on the longer end, and then we don't mind increasing the rates in the shorter end by issuing more and more bills. And we are now issuing more bills than the Great Recession in '08 and '09. We are now at depression levels in terms of the issuance of bills. Well, is the economy in a recession, Nick Timoras? Because it seems that Janet Yellen is acting as if the economy is already in a recession by issuing all of these bills. The predatory behavior comes in the fact that when we hit a recession, we start losing jobs. When we need to increase the issuance of bills, she's already done that. She's already exhausted the ammo to do that. And we're only going to be left with issuance of longer end treasuries, which means in this crash, we could see different dynamics. You see, in '08, '09, we weren't running such huge budget deficits. And to rescue the economy, the Federal Reserve, the Treasury bought bills, bought bonds, effectively reducing the interest rate in the economy to zero. And a lot of folks right now assume that what happened back then will happen now. If we get in any trouble, the Fed will just reduce rates to zero, begin buying bonds again, quantitative easing, and everything will go back happily ever after. Have you forgotten that we have a massive budget deficit? Are we going to increase taxes dramatically to make up for that when we have a recession? See, things are different this time, but they're only worse. You can see in the chart right here, the share of T-bills of the outstanding debt has surged significantly higher recently, way above the recommended target. We're reaching levels that we got to during the pandemic. So again, when folks say we don't have where's the recession, Maverick? Well, I don't know. It seems that the Treasury Department is acting as if we are, not just in a recession, but a depression right now. And of course, this week, Propaganda Minister Janet Yellen was hammered in the Senate about this issue. At least 2 senators. The rest, of course, they're bought and sold like hookers. So they didn't ask any objective questions. All they cared about is the sanctions on Iran and all of that. But 2 senators asked good questions about the massive increase in the bills and the fact that Janet Yellen is manipulating and timing the market. And she's going to screw us up later on after the elections, baby. And the best interaction, of course, was from Louisiana Senator Kennedy, who told her, ma'am, you got to stop it with the bullshit. No, he didn't say that. But he told her, my mama didn't raise me as a fool. We know what you're doing, ma'am.
I'm going to say it again. You're a lot smarter than me. But my mama didn't raise a fool. And if she did, it was one of my brothers. And what you're doing, you know it and I know it. And all those people sitting behind you know it. You're paying 5% to borrow money when you could pay 4% to borrow money. You announced you were going to do that back in November 2023. You're working cross purposes with Jay Powell.
We're not working.
And the reason you're doing this, is try to give the economy a sugar high 5 months before an election. Now, you know that, and I know that.
It was a hilarious interaction. He called her out. She couldn't really defend it. And again, predator and prey. The predator is Janet Yellen, Jerome Powell. The prey, America, baby. The whole country is a prey. And again, think about the Treasury exhausting the issuance of bills. What are we going to do in an actual recession? And if you say, oh, the Fed is going to fix it all, the Fed is just going to buy stuff. You got to remember that unlike 2008, the Fed right now is sitting at a massive loss, the largest ever annual operating loss, over $114 billion. This was not the case back in '08, '09. Are you guys beginning to understand that when this happened, it will be the biggest ever, the biggest economic disaster in this country's history? I mean, you're seeing the signs, you're seeing everything, but it's not happening right now, and everybody has the arrogance and the false sense of security that we're out of the woods, clear skies ahead, and we got a soft landing coming. Well, I assure you that turbulence is ahead, and the chances of this plane landing in a soft landing, as Jamie Dimon would say, not very good. And that's the top banker in the country. Now, we just talked about predator and prey when it comes to the economy and the future of the country. When we talk about predator and prey in the stock market, well, the freshest example is what happened with GameStop again this week. So we got a pump and dump 2 weeks ago. Now we got another one. Well, gee, what happened? GameStop Thursday jumped by more than 40%. Why did that happen? Did the company announce great earnings? Somebody buying GameStop? Perhaps they announced some streaming methodology to deliver their products. Oh no. It was this pumper, the Roaring Pussy, scheduling a YouTube live stream. Oh wow. That's going to increase the company's bottom line, right? And here comes the stream, and it was nothing but rambling, guzzling beers, talking about E-Trade, and shooting the shit. What do you know? GameStop went down by more than 40% on Friday. Pump and dump, baby. Now, we gotta understand that this man has a huge stake in this game. And after the 40% pop on Thursday, he was set up to be a billionaire. But of course, he did the live stream. It was a nothing burger. He was just shooting the shit, playing the dummies. And the stock went down 40%, but he's still sitting with a massive fortune. And the problem is he has a due date. And this due date is the monthly expiration of options in June. He gotta book his profits. He gotta dump. Do you understand that? And I think in the stream, he kind of gave you a hint. We'll talk about that in a minute. But GameStop was actually up over 30% in the pre-market session. This is before the stream. Then it went down by 20%. Rapidly. Why did that happen? This is all before the stream, folks. GameStop, the company, was supposed to report earnings Monday. They came out on Friday with a surprise announcement. They said, folks, we're doing horrifically. We're doing bad. Stop. Don't buy the stock. And they dropped it by about 20% or so. The video game seller on Friday reported a loss of $32.3 million on a revenue of $882 million in the first fiscal quarter, with declining sales of hardware, software, and collectibles. This compares with a loss of $50.5 million on revenue of $1.2 billion in the year-ago period. So the revenue went down, companies still losing money. This is not a good dynamic. What is the fundamental thesis, folks? You keep saying, Maverick, but you don't understand the fundamental thesis behind GameStop. There is no fundamental thesis, baby. What are they going to produce? Porn? Maybe that'll help the company. Maybe they should have bought OnlyFans. That could have brought the company back. Here's the important statement from GameStop. We expect the company to continue to lose money in its core business, but this is really important. Its high cash balance could throw off $100 million in annual interest income, largely offsetting losses for the next year or so. This is a really weird dynamic, folks. The company is saying, look, we are a shitty company. We keep losing money. We will keep losing money. But thank you to your stupidity in pumping the stock and pouring your money into it, what we're doing is hitting the cha-ching button. We're diluting the shares. We're selling more shares to you, donkeys. And we're raising hundreds of millions of dollars. So we have a shitty business, but a lot of cash. And guess what the predators in GameStop management are doing? You think they're going to invest the money in the business, in a dying business? You think Ryan Cohen, who already bagged you in Bed Bath & Beyond, has your best interest in mind? Or will he pay himself bonuses now? Hundreds of millions of dollars worth? I think the answer is clear. The headline from Business Insider reads, GameStop meme stock run makes no sense. And GameStop may turn it into a $3 billion windfall. You keep buying, we keep dumping shares, as any rational management would have done in the case of GameStop. At AMC doing the same, by the way. You guys want to buy? Sure. We have a ceiling on top of you. Every time you buy, every time you pump the stock, we're dumping it in your head. Because we have to. And the biggest predator of them all is this roaring pussy, Keith. Because he got to cash out. He hit the jackpot. You think he's not going to cash out of the goodness of his heart because he cares about you? Why would he do that? During the 48 minutes live stream, Gil said that he's working alone without any institutional backers, wink wink. He reiterated his support for Chief Executive Ryan Cohen, another bagger, and said he believes GameStop is in the middle of its turnaround plan. Bullshit. He also shared a screenshot of his brokerage account that showed he has not sold his giant position in the stock. Gil said he believes GameStop will transform itself into a better business, but he admitted he's not clear how. Oh, really? It becomes a bet on management and, of course, Ryan effing Cohen. I wouldn't bet on Ryan Cohen. The guy already bagged you twice. Anyhow, Gil added that we've seen enough from him. Yeah, we did. To think he's got a good head on his shoulder. He also might replace John Cena as the spokesperson for Hefty, because he has way more durable bags. Anyhow, he also said that, we're talking about Gil here, he reserves the, this is really important for you to understand, he reserves the right to change his mind and warn viewers to make their own investment decisions. Quote, none of this is advice, end quote. In other words, Keith is telling you, yeah, I'm gonna you. Get the lube ready. Shares in GameStop dropped sharply on the stock sale plains and were down 40% at the end of Gil's live stream. The stock has been halted 16 times on Friday. That's the other thing. How could you even trade this thing with all of the halts that they do all the time? It's just a shit show. But folks, let me say this honestly. If this man, Keith Gill, if he actually ends up pumping and dumping and bagging all of these morons, and walking away with hundreds of millions of dollars, I think all of us should bow down, should go down on our knees and suck him off.
We should be on our hands and knees right now, getting ready to suck this guy off. All right? Like this, okay? I want to suck you off, Steve.
And forget about the live stream. We'll do a live stream where the Maverick for Wall Street is going to go down on Keith Gill and suck him off. And he'll probably like it. He'll probably ask to suck me off after it because, looking at him, had the straightest arrow in the box. Gives me those Caitlyn Jenner vibes. Happy Pride Month, by the way. But folks, I'm going to teach you something here in investing in life as well. At the risk, of course, of alienating our female viewership. Because we got 2 ladies right now. By the end of this, we're probably going to have none. But this is really important. As sexist as it might sound, this is an important lesson. And ladies, you understand that 85% of the viewership and about 90% of traders are males. So we have to speak the same language and entertain these savages. And I think that a lot of you, either you're mamas already, or you might become mamas, and you're going to have boys. And you don't want to raise them fools, right? So maybe there's something for all of us to listen to and understand from here. Here's what I think is going on with GameStop and all of these phenomena. You see, back in my younger days, and this is the pitfall of every great man. You can be really successful in your job, in school, in college, good doctor, good businessman, makes millions of dollars. But the pitfall of this kind of man is pussy, and not just any pussy. You see, again, in my younger days, if you look at my dating history, it's the same trend, gravitating toward trouble. Troubled women, nutcases, drunks, druggies, strippers, porn stars. The kind of girls you don't want to introduce to your mama. Otherwise, she might think that she raised a fool. But you know what I thought? I thought, yeah, they got a lot of trouble. He doesn't match me. I'm a clean-cut kind of guy, doing everything by the rules, by the book. But I can fix them. It's a project. Every project I get, I fix it. I'm successful. I can do it. I can fix her. I think the ladies can relate, right? Because a lot of you, successful, good family, got a PhD, but she's dating a loser, a homeless guy, because she wants to fix him. The same thing goes on here. I thought I can fix her. We're going to fall in love. We're going to get married. And we're going to move to a small town in Utah and become Mr. and Mrs. Smith. Have pretty little kids. Have pasta with tomato sauce that tastes like noodles and ketchup. I thought I can do it. But at the end, it always ends the same way. In sorrow. Broken heart. Broken wallet, and you probably got herpes now. And it's not any kind of herpes. It's the herpes 2.0. Haven't been released yet from the Chinese lab. You're getting a pre-release special. And that's exactly what's going on with GameStop. She's hot, she got great pussy, but it's gonna end up in tears. You know it, I know it, and everybody knows it. You see, in your life as a man, you have 3 types of women you're gonna encounter. The type that you should pump and dump, nothing more. The ones you date, but don't marry. And then you have the keeper. Each one has different traits. And if you mix them, you're screwing up your life. Pump and dump, you're not using your head, at least not the one upstairs. Keeper, or you're using your head. It's a strategic decision. Do we get along? Do we think the same way? Can we raise kids together without conflict? That's more important than what you're seeing. And the same analogy is applicable to the stock market. You got the pump and dump, you got the date, but don't marry. And then you got your keeper. So let's talk about these 3 types in details. What is a pump and dump? No fundamental case. High volatility based on sentiment. Oh, he's gonna live stream now. Oh, he didn't say shit in the live stream. Oversized gains based on hype and stampeding. Believe it or not, the short float is still the same. The reason why the stock is going higher because folks are stampeding to buy it. The bull tends to be retail investors, not the sophisticated guys on Wall Street. It causes high adrenaline rush. Great pussy. But then you have the risk of being emotionally attached. And that's the biggest mistake. They gave you a narrative. David versus Goliath. You're screwing up the hedge funds, which it's bullshit. You screwed up one hedge fund. But the man, remember the man, Citadel, made the biggest profit in Wall Street's history in the year 22. What is an example of pump and dump? Of course, GameStop. You pump it, you dump it, in, out, hello, goodbye. No commitment, you don't put a ring on it. It was fun while it lasted. That's all there is. I think Keith will do the same. What is a date but don't marry kind of stock? Has a fundamental case, but usually this case is transitory. Has high volatility based on expectations, not sentiment, expectations that the growth that you're seeing right now will continue to go. So we see oversized gains based on growth. The bull in this case tends to be institutional. It's the Wall Streeters who love this stock. Absurd valuation and the risk of entering too late because you ignore it in the beginning. You say, oh, it doesn't make sense, too expensive, but it keeps going and going and going. And the moment you capitulate and you get in, it's probably already too late. Examples of a date but don't marry. Nvidia and Tesla. Nvidia is still going. Can date her if you'd like, but he ain't put a ring on it, at least not in this valuation. I mean, take, for example, Stanley Druckenmiller. He dated, but then he said goodbye. It's over. It's done. I don't care how much it went higher after I dumped. It's done. I got my VIG. I got my goal. We're done here. Tesla, same thing. If you look back at Tesla, there was a fundamental case. It is an automobile company that was experiencing massive, explosive growth. But then this growth came to an end, and the margins are now horrific. It's becoming a maturing automobile manufacturer. If you dated the stock, you bought it in 2016, 2017. I mean, you should have dumped it already back in 21 because it's a lot lower than it was back then. What is the keeper, though? The keeper has a fundamental case, not transitory, though, has low volatility, nothing too sexy here, consistent gains based on performance, not hype, not growth, performance. Can you deliver margins or not? You can have static revenue and sales, but can you increase your margins by management? The bull in this case happens to be institutional and retail alike. Reasonable valuation, pays dividend. It's worth it at the end of the day. You got it out of your system. Now you got to stick with the keeper, baby. Examples: Costco, Raytheon, JP Morgan. We can go on and on and on. Regular stocks, boring stocks in your eyes, but those are the keepers. And again, folks, I apologize for the sexist tone, but you know what? You got to grow the fuck up. You should tolerate some of the locker room talk if it's actually going to end up raising masculine men, because that's the problem in our society, the lack of masculinity. It destroys societies. And this has nothing to do with your orientation, by the way. You can be gay and still be masculine. You take responsibility. You don't bitch and whine all the time. You have self-respect and worth. You're not worshipping those oligarchs who don't give a about you. We don't want to raise fools here. We want to raise masculine men. Because look at what's going on right now. Without that, they're bitching and moaning about everything. And they got no role model. They got no self-worth at all. So they worship those oligarchs, those billionaires. Take, for example, what's going on with Elon Musk and Tesla. The stock is down. The margins of the company are down. The guy already diluted the shares by dumping billions and billions and billions of dollars worth of Tesla shares. He's already the richest man on the planet. He's moving on from Tesla. For him, it's a date, but don't marry. But for the Culties, they still don't get it. I mean, look at this post here. The Norway State Pension Fund, one of the world's largest, has said that they will vote against Elon Musk's new Tesla $56 billion compensation package. They own about 1% of all shares outstanding. I can't imagine what Elon is feeling. This is anti-capitalism, anti-American, anti-hard work. This is what happens when men becomes cucks to the oligarch. What do you think Elon gives a shit about you? Absolutely not. Cares about himself, his family, and his ego. And he wants to squeeze as many billions out of Tesla shares so he can move on to the next sexy thing, which is the AI project that he got. What do you think that will do to your shares? Don't you have any self-worth or respect when the guy already cashed out? He already got paid. He sold $7.5 billion of Tesla shares before releasing the disappointing data that plunged the shares to a 2-year low. He already got out before he screwed all of you, and you're still kissing his ass. Even the Wall Street Journal now says the case against Elon Musk's $46 billion pay deal. It's absurd. It's going to dilute the shares. He already got paid. Why do we have to pay him even more? If he can pump the stock all the way back to the highs, not via hype, but via fundamentals, improving the margins, then okay, let him get paid. But he's not going to get paid when the stock is down. And folks, again, he's cashing out because he's moving on. Tesla is his past love. Elon Musk admits that he's now diverting Tesla AI chips that he bought from NVIDIA. Remember when the hype was, oh, Tesla's going to be an AI company and it's going to be the future, brah. Now without the chips, he's using the chips for his new AI project. That's his current love. But you still don't get it. For the love of God, we need to restore masculinity in our society. And it begins with men having self-respect and self-worth. And with that lovely message out of the way, folks, let's segue to the market information that we got throughout the week. And we begin with the closing of the indices on Friday. And here we go. The diamonds in the red, down by 87.18 points, or a loss of 0.22%. The Nasdaq also in the red, down by 40 points even, or a loss of 0.23%. The Spider in the red, down by 5.97 points, or a loss of 0.11%. While the Russell 2000, yield sensitive, yields popped significantly higher after the payrolls data on Friday. So we see the IWM Russell 2000 getting hit the most, down 2.39 points, or a loss of 1.17%. Almost all sectors were down. Technology was just a tick in the green, thank you, of course, to some of the large cap names, but the laggards were led by metals, utilities, and comm services. In contrast, for the week, we have technology, healthcare, and comm services winning the week. This is really interesting technology. Thank you, of course, to NVIDIA, the overweight size of that company. Well, you see that other names did not do as well in the technology sector. What's really interesting is healthcare. We talked about healthcare as a hybrid sector. It works in expansion, works in a recession, works in stagflation, works in inflation. So every time we see healthcare down, they keep picking it up. That's a keeper, by the way, healthcare. The laggards, led by energy, utilities, and metals again. When we look at the breadth on Friday, awful. The NYSE, 23% advancing versus 75% declining. The NASDAQ, 26% advancing versus 70% declining. You look at the heat map on Friday. Most stocks were in the red. You look at this heat map and you'd say, how come the S&P 500 was down a tick? It was supposed to be down even more. Well, you got a few large names such as Apple, Taiwan, Eli Lilly, moving higher by about 1.5% apiece. You got JP Morgan, also up about 1.5% apiece, and it kind of balances the losses from smaller names. Any theme here we can extract on Friday's session? The only theme is Apple has an event Monday, and my hunch is, we've seen this before, the stock rallies before the event, and then we see sell the news. So Apple going up by about 1.25% on Friday. We'll see what happens comes Monday. But the theme all in all, weakness across the board, yields went higher, the dollar went higher, of course the stock market is upset. But we contrast this with the weekly heat map. What do you see here? You see that technology, the big caps, outperformed by a lot. The rest of the market was getting hit hard. And the reason behind the outperformance by the big caps was the drop in yields and the drop in the dollar. So there was a theme going on all the way till Friday. Then comes the report, the payrolls, and all of a sudden we see yields, dollar higher. We see a lot of the big caps underperforming. So the only theme that I can extract from this week is the fact that the healthcare names are showing incredible strength. You look at names like AbbVie, although we talked about this in the last video, a little overbought. You look at NVO, Eli Lilly, Abbott, Medtronic, ISRG. Look at the chart of McKesson, MCK. That stock been flying to the moon, and that's a value stock. The other theme that we see if you look at apparel, and we've been talking about this for a while, you got TJ Maxx up about 4% again this week, and another discount retailer, Ross, also up over 3% this week. So apparel is still hot because we see more foot traffic, since a lot of consumers are now reducing spending, but they still have to spend. But you have to understand something really important, because a lot of folks thought that Five Below will do the same thing. We'll see higher foot traffic. We did, but the stock went down big. Why? Because higher foot traffic is not going to fix their lower margins, because the input cost is going higher. But since they have a limit, 5 and below, you can't increase the price, so your margins will go down. High foot traffic or no high foot traffic, it wouldn't matter. TJ Maxx, Ross, that's a different story. Then we got Honeywell, HON, in industrials showing signs of strength. Too early to say, but that's the value industrials. If you look at Eaton, GE, Caterpillar, those have been flying way too high. A lot of the industrial names have been flying way too high because of the government spending bubble. But Honeywell been lagging, so folks are finding opportunity in this name. When we look at the heat map for the ETFs for the week, what do we see here? TLT, TMF up. That means the bonds are up. Yields are down for the week, despite the pump that we got on Friday. But it was not good enough to get any yield-sensitive sector, as we see in the IWM down. We see the XLU defensive. Yield-sensitive also down. Utilities, real estate down. XHP home builders down. XRT retail down. The KRE regional banks down. The only yield-sensitive ETF that managed to close in the green this week was the XBI Biotech. Why did we see that? Again, the oversized gains by heavyweights like NVO and Moderna. So when you peel the onion, biotech did not do pretty good. It was just outperformance by two giants within the biotech sector. And the dollar was down, folks, for the week, even though Friday went higher. But still, any dollar-sensitive name was down. Look at the XLE, XOP Energy down for the week. You look at the XME metals getting hammered for the week, down over 6%. Led, of course, by gold and silver. GDX gold miners down about 5% for the week. Silver down about 4% for the week. Any energy, even uranium, URA, was down 7% for the week, despite the dollar going down. Why? This is really important, folks. In the beginning of the week, we have seen a recession formation in the stock market. Dollar down, yields down, but equities also down. Then came Thursday, and we got the services PMI, or the ISM, and it showed that growth is still intact in services, and we've seen a comeback in the stock market. So finally, the stock market did respond to a lower dollar and lower bond yields positively. But the party did not last for too long. Why? Because we got the payrolls, they were too hot, and now we have the same old problem, which is higher yields, higher dollar, inflation expectations are higher, so the Fed will not be able to cut. You see how we went from one extreme to the other within a week? This is a really challenging market, folks. In the beginning, we were talking about a recession Monday, Tuesday. Comes Thursday, we talked about soft landing. The prices in the services PMI down. Or the ISM, Prices are ticked down. Still expansion, but ticked down. But we have seen a return to growth in the services sector of the economy. Comes Friday, now we're talking about inflation again. All of this data will be settled down this week because we have the CPI, aka the CPLI, and we have the FOMC, and on top of that, we got the PPI and the import price index too. It's the WrestleMania of macroeconomics this week. We move on to commodities. On Friday, all of them down. The dollar was up almost 1%, so we see massive losses across the board led by metals, down 6.5% plus in silver, 4% plus in platinum, copper. You got gold down a little over 3.25%, palladium down 2%, grains down across the board, softs down across the board with the exception of cocoa and lumber, up about 1% apiece. Even energy was in an oversold rebound, but couldn't finish in the green, with the dollar moving higher. Natural gas, different phenomenon, shortages beginning to show up again. So we see Nat Gas up about 4% for the day. And if we look at the weekly performances, Nat Gas on top again, up about 13.5% for the week. Cocoa with about 9%. Sugar up about 3.5%. The laggards, oats, wheat, and platinum. Let's move on to the big casino options. What do we see here on Friday? The volume exploded higher for GameStop, no surprise here. But again, the day before, the IV rank was at 100%. So if you thought that we're not going to see a dump, you should have seen it happening. Because the IV rank, once you get the 100 in one direction, leading to that 100 IV rank, you're probably going to risk the opposite move comes options expiration. NVIDIA, the volume is higher, Tesla, AMC, but we're seeing just a touch of an increase in buying puts. They're happening in NVIDIA and Tesla. The rest of the market is mostly calls. There's one bias, and that's for calls. Of course, when it comes to NVIDIA, the split is over now, and a lot of folks think that's going to be good for the stock because retail investors will be able to buy it now. You know what else gets cheaper when the stock splits? Put options, shorting. It becomes easier to short NVIDIA now. And this could work against the stock. So after all of this pumping, we see folks a little bit buying some puts. When it comes to Tesla, of course, it's all about this vote about Elon Musk's package. And if there's a disappointment, if he doesn't like the no vote, if it happens, or even if it happens, yes, on the package, I think it's going to dilute the shares. So a lot of folks assuming that Tesla will face a bad outcome either way. If we look at the bullish versus bearish flows, and this is only for out of the money. Bullish flows, we see NVIDIA, IWM, Qs, Humana, Adobe. On the bearish flow, we see the SPY, AMD, Coin, Hess Energy, the VIX. The VIX didn't have a good closing on Friday. I think that's the only positive sign that we got from the action on Friday. Because you got the dollar up, you got bond yields up, but the VIX was down. So there was no appetite, at least on Friday, to buy 30 days plus worth of protection on portfolios. Let's do the unusual activities that took place in the options market on Friday. We begin with the ticker TQQQ. This is the 3 times levered index for the Qs, the NASDAQ. Somebody's buying puts here. They're betting that the NASDAQ will go down. They bought the 62.5 puts for the expiration date, June 14th. The expectations, the name will go down and lose more than 7% of its value by then. Paid about 45 cents a piece, tenor this trade. All in all, spending about $400,000. Then we have the ticker MBLY, MobileEye. Somebody's buying calls, betting that the stock will go higher. If we look at the chart, it appears that it's already getting squeezed. Massive gains on Friday's session. I think we can make 34 before we find some resistance. And this is why somebody bought the exact number, 34 calls. The expiration date, August 16th. The expectations, the name will pop higher by more than 7% by then. Paid about $4 a piece, tenor this trade. All in all, spending about $2.8 million. Not cheap. The premiums are really, really expensive in this name, so proceed with caution. Then we have the TMF. So we're talking about bonds here, the prices of bonds. Somebody believes they're going to go higher, meaning yields will go down. And again, the expectations are the CPI at least month on month will be down because of the energy prices going down month on month. The tricky part, of course, becomes core CPI. Will that really go down or not? But if CPI comes out soft, the assumption is we'll see bonds recovering and bond yields going down again. So somebody bought the 52.5 calls for TMF with the expiration date of June 21st. The expectations, the name will go higher and gain more than 7% by then. Paid about 45 cents a piece, tenor this trade. All in all, spending about a little over $250,000. And last but not least, what about the ticker IOT for Samsara? Now, if we look at this chart, you got a report, and the report was not good, at least based on the reception of the stock. It went down big. It is oversold right now outside of the lower Bollinger Bands with higher volume I would say when I see a chart like this, I would actually bet for a rebound play, just a normal sold rebound. But here we have somebody betting for more pain to come. Maybe they see a rebound at least for a day or two and then more downside to come. So they bought the 28 puts for the expiration date June 28. The expectations, the name will go down and lose more than 8.5% of its value by then. Paid about 50 cents a piece to enter this trade. All in all, spending about $270,000. Let's move on to charts and then wrap it up. We begin with SPY, an hourly chart for the S&P. What do we see here? We talked about the risk of a cup and handle formation. We got that playing out throughout the week. Now what do we see? A little bit of stalling here in the hourly chart. You can see that in the MACD indicator. We're now turning back to negative momentum. You see it in the RSI, negative divergence. You see it in the vortex, the red line above the blue, meaning bearish momentum. You got to understand, though, that this is an hourly chart. All of this bearish momentum could be resolved by a little more consolidation, and then higher we go again. So we're not going to see any damage in this chart until we break the pattern. And the pattern right now is higher highs, static lows. You break the lows at 533.5. You close below that number on an hourly basis. Then, okay, we got something else going on here. We look at the daily chart for the SPY. We see these topping patterns, topping candles. You can call them a doji, spinning top. You can call them a ninja top. Doesn't matter what you call them. They're signs of indecision. For now, the formation, if you look at it, we have a pole. And we're consolidating in a bull flag pattern. But the candlestick itself, Friday and Thursday, showing a little bit of indecision, which could be followed by a decision candle, and that candle could be to the downside. For now, the overall pattern, the pole and the indecision, favors a bull flag pattern and a break to the upside. The decision will come to the upside. So that's the assumption until proven otherwise. On the weekly chart, what do we see here? We have higher highs in the market. We talked about this about 2 weeks ago. But as we've seen in the top in 21, we see a negative divergence in the weekly RSI. So we're not out of the woods here, folks. Got to be careful. We see a lot of weakness in the smaller components of the SPY. But since NVIDIA been holding along with Apple, we see the index going higher. If these two names, say the disappointment in the sell the news by Apple and then disappointment of the split in NVIDIA, we see these two stocks going down, along with the continuation of the weakness across the market. We could see the SPY heading down and the negative divergence of the RSI, the weekly chart, would be looked back as the telltale. If we look at the E-mini futures hourly chart, what do we see here? We talked about the tension pattern, the triangular consolidation. If we trade above 5,306, and we've done that, and also retested 5,306, and then we got a breakout. Now, of course, it got too hot in a short amount of time, and it is consolidating to resolve this overheated momentum. For now, the previous Maverick top is still holding. That's 5,368.25. You break above that, you close above that for the day. Okay, now we got clear skies ahead. If we head down to 5,306 and we lose that, close below for the day, we're going back to bearish. If you look at the Q's hourly chart, what do we see here? Consolidation, same dynamics that we see in the SPY. And again, if you lose the lows of the pattern, it could be a bear flag, but the confirmation would be losing 462, the lows of the pattern. If we lose that from an hourly standpoint, then we're going to go down, retest 457. If we lose that, we go down to closing the gap from the cup and handle. You look at the daily chart for the Qs, it's the same problem. We have indecision, doji, spinning, whatever you want to call it. Doesn't matter to me. Terminology doesn't matter. It is an indecision candle, waiting for more input. And I think the input they're waiting for is the CPI and the FOMC. And then we'll see a break, one way or the other. If we look at the NASDAQ futures daily chart, what do we see here? We got the rising wedge. We broke to the downside. For a moment, we lost the 20 days moving average, but we caught support from the 50 in blue. We never closed below the 20 though, on daily basis. Never. Once we recaptured the bull advantage line, 18,691.25, we're up to the races and now consolidating in what it appears to be a bull flag pattern. Until what? Until we lose 18,691.25. The IWM, a lot weaker though. You got the cup and handle, didn't play out. It played out in the Qs, the SPY, not in the IWM, yield sensitive. It actually gapped down on Friday's session. Now we got support at 201. If that's lost, you see here we have the opposite look from the NASDAQ. Here we have lower highs and static lows. And I think if we close on an hourly basis below 201, it'll be confirmation for more downside to come. Look at the daily chart for the IWM. We lost the 20 days moving average, lost the 50 again on Friday. And the chart appears to be expanding the lower Bollinger Bands after printing a topping head and shoulder pattern. On the weekly chart, it's the same thing. Topping head and shoulder pattern. Now closing again below the 20 weeks moving average. The next stop should be the 50 in or around the lower weekly Bollinger Bands. That will be about 191, 192-ish. The Dixie, the dollar, we see a big pop, big reversal on Friday, but is it confirmed? The answer is no. You got to close above the 50 days moving average in blue. That's 105. 0.085 basis points. If you do that, then the dollar becomes bullish again. That's not going to be good for the old man gold. See, a lot of you said Maverick gold finally broken above the 20, but I told you the Bollinger Bands are tight, so the 20 has very little importance. We said in the last episode, I'm smelling a trap here in gold and silver, a bull trap. I'm not buying the pop here until the payroll's out of the way. Comes Friday, massive flush down in gold. We see the bear flag playing out. The GDX, the same thing, bull trap. Gave you the closing above the 20, gave you the closing above 35.74, but we said you got to be careful here, folks. Let the payrolls confirm or deny. Well, the payrolls denied. So we see a massive gap down to now GDX gold miners expanding the lower Bollinger Bands. I think it's heading down to 32.43. The same with SLV silver, massive trap, gave you the closing above the 20, but, and I said verbatim, it could be a trap, folks, and it was. Now we lost the 20 days moving average. We lost 27.24. I think we head down to the lower Bollinger Bands in or around 25.5. When we look at UK oil Brent, we were betting this week on an oversold rebound via USO calls. We got it pretty good. Now, I was not participating in Friday on Discord, but folks, it is obvious. I said once we get to 73 in the USO, you got to close those calls because the risk right now, if you did not, it's not a big deal, but you got some risk here. And the risk is if you look at the UK oils chart, what if this is an inverse ABC pattern? We finished with the B leg and now we do the C. We break 76.65 as support. The data that we're about to get from the CPI is really important. If it points out to a recession, then you bet UK oil will go down and play the inverse ABC. If it points out to sticky inflation, then we'll actually go higher and trade above 81. But there's a huge risk right now for an inverse ABC. If we look at the daily chart for the 10-year yield, what do we see here? We talked about the risk of stretching the rubber band down, as we've seen before. We see huge rebounds after that. Well, Friday we got a huge rebound. If we plug in the Bollinger Bands and the 20 days moving average though, we did not close above the 20 as you can see in white. So we have no confirmation yet that the 10-year has indeed turned to bullish. I think the confirmation you want to wait for, so you don't fall in a trap like gold and silver, is let the CPI and Powell, the FOMC, let that get out of the way before you make any assumptions. Sure, the PPI will come out after. The import price index will come out after. But I think that the tone set up by the CPI and the FOMC will dominate for the week, regardless of the PPI and the import price index. When you see a huge pop in the 10-year, what do you think is going to happen to the XHB? Home builders. On the weekly chart, it appears that we are on track for an inverse ABC all the way down to the lower Bollinger Bands in or around 95. Now, in the short time frame, though, the daily chart, we are the lower Bollinger Bands, and every time we got a touch of the lower Bollinger Bands, we got a rebound. The assumption is we might get a rebound in the daily, but so long as we stay below the 20 weeks moving average or break it again, you got to assume that in the weekly chart, the longer time frame, we do have an inverse ABC. So you take any rebounds in the daily as an opportunity to enter shorts on the weekly chart of the XHB. The IYR in the weekly chart, not as decisive as we see in the XHB. Still consolidating in lower lows and lower highs, but there is no decision in the break yet. Keyword yet. On the daily chart, we lost the 20 days moving average. We're seeing a beginning of a topping head and shoulder pattern. And if it plays out Monday, we reach the lower Bollinger Bands in the daily, it will probably at that point break the trading channel, downward trading channel on the weekly chart of the IYR. The KRE Regional Bank's daily chart, it is showing the topping in his shoulder, and now we formed the bear flag pattern. And since the Bollinger Bands have expanded, so you see the gap below, that was an opportunity to buy, at least for a trade. Then we got a bearish engulfing candle. Okay, now we short. And the Bollinger Bands has now expanded to allow the chart to go down even further, breaking the support of 47. If that happens, then understand that we are indeed heading lower. The XBI Biotech weekly chart, another yield-sensitive ETF. We couldn't get the close above the 20 weeks moving average though. And that's the problem. We closed above by a tick. It doesn't really count. So unless we close above 92.95, which is my bullish advantage line, I'm not there yet. I think the risk of a topping head and shoulder is still here in the XBI Biotech. If we look at the VIX, this one broken below the 20 days moving average. That's bearish. So you got Dixie bond yields giving you bearish signals for the stock market, but you got the VIX giving you a bullish signal. How do we resolve all of this? The answer is you gotta wait for the CPI and Powell FOMC, and that's going to decide what's going to happen this week. You look at the big Kahuna apple, what do we see here? Above 192, that means it is bullish, but the upside is limited. You got the upper Bollinger Bands. If we do get sell the news on Monday, then we're going to have a juicier trade all the way to the downside. I'd rather be participant in that one, all the way down to the lower Bollinger Bands, which would be a downside of about 6.5%. So I want to go with that trade after a confirmation, but I don't want to chase right now the upside trade because it could be limited. If we look at Tesla, souffle, what do we see here? Daily chart, been consolidating, doing nothing at all, eating away time and eating away your premiums when you're betting on options, weekly options. The energy is going to be released, folks, one way or the other. And I said if we have another close above 180, it's going to be to the upside. But the risk of a downside break is also highly likely. I think it depends on the package for Elon Musk. You look at NVIDIA, hourly chart, what do we see here? Bull flag played out. Then Thursday, we got a bearish engulfing candle in the hourly. And now we're debating, are we seeing a bear flag pattern? And the answer is, it looks like it. Maybe folks will pump and dump the split, at least initially, and then close some of these gaps that you see here. All the way you got 1,000, you got 974 and below. So we have plenty of gaps to fill if we decide to go down in NVIDIA. And again, the puts will be cheaper. And I think that folks will take advantage and actually short NVIDIA, not buy it. If we look at Bitcoin, tulips, what do we see here in the daily chart? We're using a line chart just to illustrate for you that it looks as an inverse in a shoulder. Once we have a closing above 71,500, I think we have a confirmation for the inverse in a shoulder, and Bitcoin will make higher highs. With the weekly chart, though, we do have a risk. If we don't close above 71,500 and we break 67,000 instead, then there is risk that we could form the maverick top. I think it depends on the dollar. I think it depends on the FOMC because the dollar depends on the FOMC and the CPI. So let's segue to the conclusion of this video. What do we have in the economic calendar this week? Monday, we got nothing. June 10th, nothing is going on. So it could be a day where the technicals and the mechanics, aka the market maker, dominates. If we look at Tuesday, June 11th, we have the NFIB Small Business Optimism Index. Wednesday, that's when the action begins. June 12th, we have the CPI, the FOMC rate decision and the conference by Jerome Powell. Thursday, the 13th, we have the PPI, Producer Price Index. That's the most important piece of data, but it comes on top of the initial jobless claims. And lastly, Friday, the 14th, we have the Import Price Index, highly important. And of course, another market mover in the preliminary rating of consumer sentiment because it comes with inflation expectations. Interesting week ahead, folks. We're going to cover it step by step, day by day. Folks, if you enjoyed the show, help us out here by giving us a like, a nice comment, subscribing, and consider being a member here on YouTube or Patreon. Now, if you did not enjoy the show, please go ahead and yourself. But this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
And I decided to complicate my life. For a guy who likes sure things, I was about to bet the rest of my life on a real long shot.
We're not getting any younger. Don't you think it's time? Aren't you getting tired of all this shit? Banging around, hustling around?
What, are you trying to handicap me?
I'm gonna do you one better. I'm trying to marry you.